Hello, everybody. Welcome to another week of Investor's Guide to Thriving. I'm doing an early pre-tape this week because as you're going to be watching this, I will have already had my back surgery. Hopefully they don't cancel it again. So we're doing a little bit of a pre-tape here, and it's still going to be all the great information that you always get. But we're not going to be doing any live questions on the event tonight. So with that in mind, again, we, as always, a quick thank you to all our sponsors, and especially to BMO ETFs. We've got a great guest tonight. BMO's been our partner in the ETF educational space for the better part of a decade now, and really excited. We launched our first fund with BMO in 2013. So it's coming up on 10 years. So pretty exciting anniversary coming up for us there, and a great thanks to our partners at BMO. And as always, we do these events educational focused. I'd like to, give investment ideas. I know when BMO comes on, and I introduce our guests tonight in a few minutes, they're going to tell you that it's, what they're doing is educational and it's not investment advice. And I'm going to tell you the same thing, that I'm not giving any one individual specific person investment advice. It was about 10 years ago where I said something on BNN, like I thought the markets were going to correct 5 or 10%. And someone out there went and liquidated their whole portfolio based on what Larry said on Berman's call. And I bumped into this gentleman on an airplane maybe a few months later after that, and he was very upset with me because he said, well, you told me to liquidate my portfolio. And I said, what? And he said, you said there was going to be a 5 or 10% correction, and so I sold everything. I said, well, sir, we generally get a 5 or 10% correction once every 10 months. It's actually completely normal. And in most cases, unless we're going into a recession, it's a buying opportunity, not a selling opportunity. And anyways, it was a very interesting conversation for 4 hours. But that speaks to exactly kind of what these educational formats are, and why I try to teach you how to make a better decision as opposed to, giving you a stock tip. And if you do learn things from our educational efforts, please, when you get the email following up to these events, there are a couple links there. Donation to cancer research at Sick Kids Hospital, something that's very near and dear to myself and my partners at ETF Capital Management and Quintessence Wealth, and dementia and Alzheimer's research at the Baycrest Foundation and Hospital here in Toronto. World-class facilities, both of them. They do wonderful things for all Canadians, and everyone really benefits from it. And I know this time of year, everyone has their special causes, but again, if you want to thank us for these educational efforts, please do that with the link so that we can match your donation and double up to a total of $25,000. So moving on, our only guest tonight, joining us from BMO Exchange Traded Funds, is Mirza Shakir. Mirza's got a great presentation tonight, focused in on sector investing and looking at different sectors. So tonight I'm going to talk about relative strength analysis, and that's really at the core of what Mirza is going to look at tonight. And is, when do you overweight a sector? And ETFs are just great for that. So Mirza, please take it away.
Thank you for the introduction, Larry. As Larry has mentioned, today we'll be covering sector investing, in particular using ETFs to tactically invest in certain sectors or express views in particular sectors. Next slide, please. So before we begin, let me preface this talk by saying that all this material, this talk is meant for educational purposes only, and is not intended to be investment advice. Having said that, let's begin, starting with the next slide. So one key question is why use ETFs for sector exposures? And one argument that comes up is why not use individual stocks in a particular sector, say using US banks instead of a US financials ETF for sector exposure. Why use an ETF? And there's numerous answers to that. There are numerous use cases for why an ETF makes sense over individual stocks. For one, using one vehicle in an ETF is oftentimes easier than an investor putting in the time, the effort, and getting the data to select what stocks they need to put into a fund to get that sector exposure. So it's kind of like a one-ticket solution. On top of that, ETFs offer diversification because they hold like a basket of different stocks in a particular sector instead of an investor using maybe a couple of stocks, 5, 10. ETF can literally look at the sector, look at all the names in the sector, and construct a portfolio in accordance with the exposure that the investor wants. And that's done in one ticket, so that's oftentimes easier. On top of that, ETFs have liquidity benefits. As we know, ETFs offer secondary market liquidity, which comes on top of the primary market liquidity of the underlying names. And that's important for certain sectors because if you look at certain sectors, let's say looking at Canadian banks using the ZEB, BMO's Equal Weight Banks Index ETF, or Canadian REITs. If you look at the Canadian REITs Index ETF by BMO, by the ticker ZRE, you'll notice that oftentimes ZEB and ZRE trade at narrower spreads to the underlying names that they hold. So that means that these ETFs have narrower bid-ask spreads compared to the underlying names that they hold, which means that if investors use these ETFs, sometimes they'll find that these ETFs are actually cheaper to trade. So there are lower transaction costs and lower trading costs that come with using these ETFs, on top of the diversification benefits that they get from using sector ETFs, as opposed to just individually selecting and trading the stocks. And then ETFs also take care of rebalancing either quarterly or semi-annually, and overall just gives a better experience for the investor. As you can see on the slide, we kind of have a single stock in Microsoft there, and we have the BMO screening tool that gives you ETFs that give you significant exposure to Microsoft. So instead of, if an investor is looking for IT exposure, oftentimes they'll look at, okay, maybe I should invest in Microsoft. It's an IT name, it's a prominent name, everyone knows about it. However, if you just get IT exposure to Microsoft, you're exposed to single stock risk. If something goes wrong with Microsoft, if something happens, earnings aren't as good, what will happen is even though you have exposure to the sector, you are exposed to any idiosyncratic risk that comes with holding just one name in Microsoft. So if you look at the slide or the image on the right of the slide, you look at all the ETFs that actually have significant exposure to Microsoft. So using this ETF, you can get significant exposure to Microsoft, and then you get the benefits of diversification and liquidity that come with holding this ETF instead of just holding on to Microsoft. Next slide, please. So here we have kind of this chart that shows you all the sectors in the US and how they have returned every year over the past 10 years. Now, I won't bother you by looking at each single sector for each year, but I would like to note that if you look at the top row, it shows you the top performing sectors across each year. And if you look at the bottom row in particular, you'll also see the worst performing sector in each year for the past 10 years. And an important thing to note here is that sectors, the best performing sectors, change every year. So there's no one sector that's consistently the best performing sector each year, and there's no sector that's consistently the worst performing sector each year. And that's important to note because if investors try to trade tactically, either they're overweighting or underweighting certain sectors versus the broad markets, there's opportunity to generate alpha. And as you'll see here, the sectors change depending on where we are in the economic cycle. So for example, energy stocks or the energy sector might do well in like a late cycle as we're getting higher inflation, higher interest rates, whereas something like technology may do well when we're in an economic expansion. Corporate profits are growing, there's growth, So it really depends on where we are in the cycle. So that's important to note that from year to year, trading tactically with sectors can make sense in terms of generating alpha for your portfolios. Next slide, please. So an important consideration is what approach should you take to sector ETFs? And there are two more common approaches. One is the market capitalization weighted approach, and the other is the equal weighted approach. So market cap approach is kind of like a pure play approach in the sense that you take all the names in the sector and you take in the fund, when you're constructing the fund, you take weights proportionally. So the larger names will have larger weights in a market cap portfolio, and the smaller names will have a smaller weight. As the name suggests, market cap weighted. One drawback of this approach is that you can have concentration risk. Where in a sector which is dominated by a few big players, you'll have more weighting to those sectors, and you could have them very concentrated to the point that the returns of the portfolio are heavily dependent on these few names. So from a diversification perspective, that kind of exposes you to more company-specific risk. If one company does not do that well, what will happen is that the entire portfolio will suffer. So it can really depend on what the sector is like. Using an equal weighted approach kind of solves for this problem, where you're looking at all the stocks and you're dividing and allocating weights proportionally or equally. So if you have 10 names, you're allocating 10% of the portfolio to each name. And that kind of gets rid of the concentration risk that you may have. The drawback of this approach is that you have a mid-cap basis in the portfolio, because what you're doing is you're taking the larger names and you're cutting down the weight. You're taking the smaller names and you're increasing the weight while keeping the middle level names kind of constant. There are certain alternative market capitalization approaches that you can also take. And these approaches say start with the market cap weighted approach, but they set a threshold for what one name can be weighted in the portfolio. So for example, if one name goes to 15% of the portfolio, it could be capped at 10% or 8% or 7%. So that kind of tries to achieve the best of both worlds. But I would say that the market cap weighted and the equal weighted approaches are more common. Now, which approach you should take depends on the sector. So some sectors have names that are more equally weighted, relatively homogeneous, kind of same in terms of size. But some sectors are heavily dominated by a few names, in which case maybe an equal weighted approach makes more sense. So it really depends on the sector, and the approach you take kind of dictates the risk profile you have depending on that sector. So as you'll see in the next slide, here we have an example of the BMO Equal Weight REITs Index ETF versus the iShares S&P TSX Capped REIT Index ETF. So ZRE, the BMO product, is equal weighted. XRE, the iShares product, is market cap weighted. And you'll see what I'm talking about in terms of the risk profile of the sector, which is REITs, Canadian REITs in this case. If you look at the returns, ZRE has been outperforming XRE, so equal weighted is doing better than market cap weighted on a 1-year, 3-year, 5-year, and 10-year basis. Since inception, the returns are kind of similar. But because there's deviation in how they do across different time horizons, you can see that the risk profile of two are slightly different. And that is because if you look at XRE in the bottom right-hand corner of the slide, you'll see that XRE is heavily concentrated in its top 3 names. So the topmost name is 14%, RioCan, the second top name, is 11%, and the third name is 8.5%. So you have 35% of your fund's exposure in these 3 names. So your fund is kind of concentrated or is tilted towards the higher cap names. With the BMO product ZRE, we have the equal weighted approach, which means that the top 3 names are less than 15% of the index and the fund. So it's kind of changing the risk profile where the first 3 names are 15% in one case and 35% in the other case. And that's kind of dictating the difference in returns, which kind of changes the risk profile. If a sector is not very liquid, does not have a lot of names, there's deviation in the sizes of the names in it, then maybe an equal weighted approach makes more sense. Next slide, please. So here we have another example. This time we have the utility sector in North America, and so Canada and the US. And here we have again the equal weighted approach versus the market cap approach. Now here you'll see the S&P TSX Utilities, the market cap product by iShares is capped. So there's a certain capping factor there. However, even after that capping factor, you will see that the top 3 names are making up a large percentage of the portfolio. So Fortis in XUT, the market cap product, is 18.6% of the fund. So the 3 names, the top 3 names in XUT, which even after capping are about, let's say 40 to 50% of the portfolio, which is significant. You have concentration risk. If there's, one of these names does not do well, the entire portfolio can suffer from a risk return perspective. Whereas if you look at the BMO equal weighted product, you'll see that the top 3 names are not as heavily concentrated or not making up a huge percentage of the portfolio. So we have about 20% of the fund roughly is made up by the top 3 names, which compared to 45% is significantly less. It kind of changes your risk profile. So this approach, or which approach you take, depends on the sector you're looking at. So I would highly recommend looking at the sector you're in, looking at its liquidity, looking at how broad the universe is, looking at the deviation in the sizes of all the companies in it to kind of dictate what approach you should be taking. If you look at the returns of ZUT versus XUT, you'll see that on a 1-year basis, ZUT is underperforming, but over a longer term basis, it's outperforming. So as I said, the risk profile kind of changes, which is why you'll see some deviation in returns. So it's important to select the appropriate methodology for the sector you're looking at. Next slide, please. So here we have kind of like a roadmap of the BMO sector ETFs that we have here in the BMO ETFs team. So we're kind of divided and we look at it in terms of 2 lenses. So we're looking at where we are in the economic cycle, and that kind of dictates the sectors that are more defensive versus sectors that are more cyclical. So defensive sectors tend to do well in recessionary times because their earnings aren't as affected, whereas cyclical sectors tend to do well in economic boom times where corporate profits are going, consumption is increasing, investment is increasing, and that tends to hold or do well for them. So you'll see from the defensive sectors, we have the ZUT, the utilities, REITs, even infrastructure, healthcare. Whereas on the more cyclical side, we have the financials, we have energy, so that's ZEB, ZEO, and we also have the base metals. Also, when you're thinking about sectors, you want to look at the geographical diversification that you would like in your sector portfolio. Because while you're looking at one sector, it's possible to go across countries to get the same exposure, but add the global diversification element to your portfolio. So you'll see here that we have certain Canadian products like Canadian banks, you have US-based products like US banks, North American oil and gas as well. And on the right side, we have the more global funds like consumer staples, base metals, global communications. So again, there's kind of like almost every flavor for every type of investor, and really depends on kind of the economic cycle you want exposure to, or economic cycle you believe in, and the geographical diversification that you would like. Next slide, please. So an important question here is, okay, I decided the type of sector exposure I want. How do I implement it? And as I just mentioned in the previous slide, you have to look at where we are in the economic cycle, because different sectors tend to perform better in different market conditions. So we have the economic cycle, we have the booms and busts, right? So we have the peaks and the troughs. So we go from recessions and we go to expansions and back to recessions, if you look at the economic cycle theory. So as I said, defensive sectors like utilities and healthcare tend to perform better in recessionary environments just because the earnings are less sensitive to where we are in the economic cycle. These are more stable sectors. They tend to not have much volatility in their earnings, and they're not as exposed to the different cycles. So if you're looking at more defensive exposures, these sectors would make more sense. If you're looking at more cyclical sectors and financials, energy, information technology, tend to make more sense because here you're exposed to the growth, and this is what we're experiencing in this stage of the cycle. We're experiencing growth. So you want sectors that benefit from this growth. Next slide, please. So yeah, so now that we've looked at basically how to construct sectors or which approach to take, very important, it's to look at portfolio construction. How do you integrate these sector ETFs or sector exposures in your portfolio? And again, that depends on where we are in the economic cycle or where we are in the market cycle. So there are four stages or four kind of stages that we've pointed out here So we have the early recovery where we're over a recession, we're kind of growing, monetary policy is loosening. So there's more growth, and in that growth, investment and consumption are rising. So you want sectors that benefit from that. For example, financials, banks are lending more, consumption is great, so credit card balances, revenues are increasing. Consumer discretionary is a good sector because consumers are now spending more. Real estate starts recovering as well. It's one of the early recovery sectors. So those sectors tend to do well. When you go to the mid-cycle where growth is kind of peaking or going towards the peak, corporate profits have expanded, you want some exposure to sectors like information technology, maybe even communication services, sectors that are kind of benefiting from that rise or towards the peak. Then we we end in the late cycle stage where we are maybe getting higher inflation, interest rates are rising, monetary policy may be tightening as well. So you want sectors like energy and materials that are more real assets based that tend to perform well in the cycle, and they can counter inflation, maybe do well in higher interest rate environments. And then finally, when you have a recession, and as I said, you want sectors that are less vulnerable to earnings going down because of a recession. So spending in these sectors kind of remains relatively constant, just because of the sector they are, like healthcare and utilities, things that are more necessities. But it's important to kind of look at sectors and how can you generate alpha by tactically trading sectors. So let's look at this market environment. 2022 has been a painful year for a lot of investors. A lot of asset classes are down, be it stocks, bonds, a lot of sectors are down as well, and down significantly. So there's been a lot of pain in the markets. But if you look at it in terms of where we were in the cycle, a lot of the pain has come because we have rising interest rates. And we have rising interest rates because we have higher inflation. And we have higher inflation because oil prices have risen a lot just because of geopolitical conflicts and supply chain issues, which are partly due to COVID as well. So kind of we've diagnosed where we are in the market cycle. It's kind of a late cycle environment. Energy prices have risen a lot that have created high inflation and higher interest rates. Now, for investors were to tactically position themselves and we're holding on to a fund like ZEO, BMO's oil and gas energy ETF, you would have experienced, or an investor would have experienced, significant double-digit returns just this year. So I think ZEO is up slightly more than 40%. And if an investor had tactically allocated to ZEO or the energy sector, they would have significantly outperformed the market and also had added better diversification to their portfolios. So even in a painful environment like this, using sector ETFs would have really helped the portfolio and have really helped boost returns. So this is just one example of using sector ETFs, being right with your calls on where we are in the market cycle can add a lot of alpha to the portfolios. And this is a prime example of how sector ETFs can really help investors. And on top of the other benefits, as I said, of diversification, of liquidity, and the approach you're taking to constructing a sector ETF. On that note, I'll finish. Thank you for the time, Larry. And over to you.
So wow, that was very insightful. Thanks very much, Mirza, for focusing on sectors and for my part of the presentation tonight, I'm going to do the same, but I'm going to dig in a little bit more meaty into the charts and look at relative strength. And we're actually going to look for tax loss selling opportunities within sectors and within ETFs. And don't forget, every week there's going to be some great information on the ETF Markets Insights that BMO hosts on Friday. This week's topic, disruptive innovation. So that should be really, really exciting. I've done an interview with Kathy Wood myself, and that's going to be on the final episode of this season of our Investors Guide to Thriving webinars that will be on December 8th. So make sure you see that one. It's going to be pretty exciting. So as always, if you haven't taken the opportunity yet, please follow us on YouTube. It's gonna, in the future and currently, be the repository for a lot of the way we communicate with with BNN viewers and our followers through social media versus a lot of the other media platforms. We've found that YouTube is one of the most effective channels for us. So today's agenda, two things: relative strength analysis, and I'll get into the definition of that. And this is very different than the RSI indicator. This is relative strength, relative performance. And then with that lens, this time of year, we're going to look for sectors, and within sectors, stock opportunities as we get into tax loss selling season. So a lot of questions always come up around this time of year on, should I buy this? And I'm going to give you a little bit of insight into my lens here on how I go about doing these things. So starting off, what is relative strength? Well, it's the comparison of the change in price between a sector or a stock and the index or the benchmark that you're actually trying to outperform. So at the very basic level, an ETF, you can buy the Vanguard Total World ETF, ticker symbol VT, trades in the US. I don't know, it's 10 basis points or something, like really cheap. You get every stock in the world basically. So at a very simple level, what should someone hold? It's the entire world of equities in their portfolio. And then the question is from there, where do you want to emphasize? Do you want more financials? Do you want more banks? Do you want more utilities like we heard tonight from BMO? BMO's got a lot of great ways to place sectors in healthcare and banks and financials and commodities and base metals and gold. And so what sector, when do you do it, how do you do it? So it's relative strength analysis that helps a lot with that. And I've got this default screen that we've set up here. And in this case, we're looking at a stock of GM. And the red line at the top is the analyst consensus target. And I like to look for, well, let me explain the rest of the chart before I get into that. So I've got the black line, that's the 200-day moving average, so basic technical indicator. And below that, the pink line is the relative strength of GM versus the index that I'm trying to beat. And in the US market, it's the S&P 500. So that's an important chart and relative strength benchmark. And these blue lines, these dotted blue lines going through both the charts, this is a 4-year business cycle window linear regression. And what it tells me on trend is, where are we at the top of the trend and where are we at the bottom of the trend? The middle line is neutral. And then each dotted line above that is 1 standard deviation and 2 standard deviations. So what I like to look for when I'm looking for something of relative value is in something that's trending higher, ideally, and buying it on a pullback to the lower end of that trend. So you can see from a relative performance basis, this pink line is generally flat. So what it tells you is that over this 3-year window we're looking at here for GM, it was about neutral to the S&P 500 in terms of performance. When that pink line was rising, GM was outperforming the index. And when you look at it and you go back in time, that 100, that 100 is neutral. So at the peak, it got up to about 125, and at the trough, it was down to about 60. So from where it started at 100, it underperformed by 40%. It went from 60 to 120, so it outperformed the index by 2x. And where it is today, since the beginning of this chart, it's underperformed a little bit. So you want to buy a stock that you want to own, and you want to identify a period where it's cheap by at least one, if not two standard deviations from the median. And then what we look at is the RSI, Relative Strength Index. This is the overbought, oversold, Wells Wilder version of GM itself. And then on the bottom, the RSI of the relative strength line itself. So I'm looking at the absolute relative strength and the relative relative strength. And I want to identify a period where we're oversold and we're creating some divergences and so forth. So that's kind of what we're looking for when we are looking for any stock in particular. But when we're into a period of like we're in now, which is tax loss selling, what we then want to look for is to identify at a high level the worst performing sectors and stocks and begin to, our analysis. So let's start with that in mind. And so this graphic today is looking at the TSX. Okay, so I'm looking at individual names in the TSX year to date. The best performing names, obviously, a lot of the energy names are in there. Think I got a question this week on Tourmaline. Obviously, a big plus performer. I think someone asked about Cenovus this week and whether I would buy that or not and what the long-term outlook, and I gave them some color on that. But on the bottom, you have the names of the worst performers. So let's look at the one that everyone loves to hate, that was a year plus ago, the biggest stock in the TSX, that I absolutely hated because this company makes no money. And so very hard to value in a bubble situation. And of course, now with the benefit of hindsight, when the punch bowl of easy money got taken away, what stocks perform the worst? It's the ones that are most overvalued. So we're going to have a look at Shopify. And in the US, when you look at the list of names of industry groups, so there's 158 industry groups in the S&P 500, 500 stocks, 158. Each group might have 1, 2, 3, 4, 5, 10 maybe in some stocks in it. So when you look at what the worst ones, automobile manufacturing, and that's kind of what identified GM to me as a name that I might want to consider for tax loss selling purposes. So you can look at it on a sector base, and then you could look at it on a sector weighting or economic sector weighting, and then use some of the sector ETFs if you want to play the whole sector. Or you can drill down an extra level, look at the individual names, and you can identify some, like Canopy, for example, is a name that I'm very interested in accumulating right now, and we are playing that name, but I'm not playing Shopify at the moment, and I'll get into telling you why as we get into the presentation tonight. So, question is it time to shop? And so here's the same chart, except this chart I don't have. I do, because I have the US version here. So I have Shopify, but I have Shopify relative to the S&P 500. And then I've got the price target. And the thing with stocks like this and analyst price targets is, you get the stock moving, you get earnings. That's what these green E's are here. So that's the earnings. Green means it beat earnings. Red means it missed earnings. And then you get the analyst consensus changing price targets as earnings come out. And you can kind of see that analysts generally chase the market up and then they get to a point where it can't go too much higher, but they keep their price targets up here, even as the stock's coming down. And then even though they beat earnings, they lower their price targets and they follow the stock down. And that's the kind of Wall Street game where, really speaking, analysts don't have a clue and they're out to lunch. So while consensus price targets matter, they do matter, you have to understand how they're driven. And when a name is speculative and doesn't have earnings, and they're trying to guess what this thing's worth in a market environment that's speculative on easy money, they're going to be way behind the curve, which explains the up move. And they're going to be way behind the curve on the down move because mentally they've got these high multiples that they're willing to value at enterprise value to EBITDA and all kinds of price to sales and all kinds of these metrics that they frankly make up to value these names. And then it gets to the point where you're starting to see, a flattening. And so you had this huge break in these very expensive names. And now you're starting to see a technical base. But this base that's developing has got, like a 40 or 50% price band. And for a lot of people, that's a lot of noise. So the base is forming. But what I ask the question of is, the breakout. What turns this? What makes it kind of move higher? And so when you look at it, you get the sense that a bottom's forming. And so from a tax loss based selling perspective, you'd say starting to get interesting, but how do I own it? At what price? Do I just buy it here? Is this the bottom, and so forth? So I do like to look at the analyst targets. I do like to consider the quality of the analyst and their ratings. And there's a bunch of things you kind of look at here, but when you kind of look at the average price and the more recent ones are current. So as of the most recent earnings, you got a bunch of ratings changes, and you can see pretty much from the mid 30s into the low 40s where a lot of these guys are. So not surprising that out of the 49 ratings on Shopify, 38 of the 49 have actually disclosed their numbers. Some of them don't. That's the average, about $40. And so currently, the stock's trading at, and we're doing this on Monday because my back surgery is on Tuesday, 36.59 as of when we clipped this on Monday. It's probably on the weekend when we did this. And so, you've got less than 10% upside. And to me, that's not a great risk return. Now, the analysts could be wrong because they often are on names like this. But to me, right now, the risk return is not attractive. So let's blow up the chart and look a little bit closer. And so here's our pink relative strength line. And we could see, it jumps around, pretty significantly. In terms of its relative performance. And so when we look at this, we basically can see, it got up into the 40 price targets. It's coming. There's just not a lot here. You can see that overhead resistance at 40. It's failed there a number of times in the last 6 months or so. But at the bottom of the range, 30 or below, it starts to get interesting. So that's kind of where, if you're looking for a tax loss opportunity on a name like this, to me, you'd want something below 30. Where exactly, I don't know. So how much would I own right here? If my 12-month forward price target's 40, it's failed there a few times. The answer is not much. The answer is not any at all at this point. But below 30, it starts to get interesting because now I've got potentially 30% upside. At 25, I've got 40 or 50% upside before you start hitting those resistance levels again. And so I think about risk reward that way, but fundamentally, you've got to kind of do your work here. Now, you've got to have a source for looking at these forward-based revenue targets and earnings per share and adjusted earnings per share targets and kind of the growth rates of them. And you kind of look at it and you say, okay, so 2024, 25, 26 for Shopify, they're projecting that they start to earn some money here. And so let's say by 2026, they're earning 80 cents a share, just easy math. And the stock's trading at $40. So, you know, what's the PE at that point? And so you could see by 2026, back of the envelope there, we're trading at about a 20 PE. 2025, you know, at 50 PE. 2025, you're trading at 100 PE. And 2024, you're trading at like 250, 220 PE. So, you know, the stock is not going to be value for quite a while into the future. And so what do you pay for it today? And again, there's all kinds of enterprise value to revenue, and they, you know, if you read the analyst reports, they kind of talk about different ways they price things. But, you know, on a forward earnings perspective, there's the forward perspective based on the 2024 numbers, 204 times, you know, and 4.8 times sales and so forth. So, you know, the stock's trading still very expensive, but relative to where it was, right? So then let's get back to the stock here. So, you know, is it gonna do this anytime soon? You know, what it did in the bubble? And, you know, for me, folks, the answer is no, not even close. This is a range trader at best for a long period of time, could be several years, where, you know, maybe you see a run to 60 and maybe a, you know, but it's not going to go back to those huge numbers we saw. This is the equivalent of the tech bubble bursting in 2000. And for a couple years, the stock's falling 70, 80, 90% and taking the better part of a decade to get back to those levels plus. And that's where Shopify is. It doesn't mean that it's not going to be, you know, an eBay or an Amazon or whatever, you know, 20 years from now, or when it, you know, 10 years from now. But that's how you have to think about it for now. So if you're asking me about Shopify, or most high-flying tech names that were inflated tremendously on easy money, that's not coming back anytime soon. So when you're looking at names for tax loss selling, this is one we can trade. If you're buying it below 30.25, you can think about plugging your nose and looking at it in 5 years, and maybe it's a double. If you're lucky at 25, it's a triple to 75. That's a bit of a stretch, but if you're buying it at 25, could it hit 50 at some point in the next 3, 4, 5 years? Yeah, probably. So that's kind of how you look at it. But if you buy it at 40 and you're upside 50, maybe in 3 or 4 or 5 years, like that risk reward again is not terribly attractive there. So that's really how I think about some of these things. That's how I look at the charts. That's how I look at some of the fundamentals. Folks, if you don't have the tools like I do, or something like that, where you get a sense of how to value a name like this, then it's really hard to do that and you know, figure these things out, especially for the more speculative names. Now, the next name we're going to look at here, because this is, you know, on the sector basis, the banks have performed pretty poorly. this year. And you can see Bank of Nova Scotia at the beginning of the year was, up in the 90 range, and now it's under 70. So pretty significant. But this is a different type of company. This is a mature, dividend paying, long, consistent track record of earnings. And so it's much easier, from a tax loss selling perspective. And you could see that relative, and in this case, I'm looking at it relative to the TSX, okay, not because I'm looking at the Canadian version of this, not the Shopify US that I compared to the S&P 500, that it's about as cheap as it was during the depths of COVID compared to the TSX. Thumbs up, that's a real positive there. And from a trading perspective, it looks like we've got some, not divergences building, but definitely some oversold conditions, so that this starts to get very interesting. And our price target forward basis is up here in the low 80s. And so at 70, not quite 20%, but, pretty close. Again, relative to Shopify that was less than 10. And a name like Shopify, you got to look at 20, 30, 40% upside, because you got a lot of volatility risk there, where you definitely have volatility risk with Bank of Nova Scotia, real estate, and I talk about all that. But it's now a stock that's back below pre-COVID levels. Pre-COVID, we were up in the 80s here. And as the market started to break, now the bottom of this was into the 50 range. Didn't stay there for long, and really based out in the upper 50s and lower 60s. And then, of course, we had vaccine Monday, Pfizer Monday, and then everything just took off from there. And that was a big point here. So, it's now come back into that value range, which to me says, hey, here's a name. So this is a name that we've been accumulating for the last couple months here in the mid 60s. And, at 70, I like it a little bit less, but in the mid 60s, to me, very, very, very attractive. So, let's kind of have a look at what the recent analyst targets are. And you've got Paul Holden, who I don't know, from CIBC, but he's a neutral on it with a 77 target. And if the last is at 69, it's, 15% upside. Where BMO's at an 86, they call it a market perform. So sector perform, market perform, neutral. These mean they expect it to move in line with the market, or very specifically their universe. And all these guys are financial, bank analysts, insurance analysts probably, but mostly banks and financial institutions. And so their rating is relative to their index or to the market. And whether it's a buy, so you have this guy at a buy at 72, where you have this guy equal weight with a target of 86, and this guy at 95 with a sector perform. So he's saying it's going to perform equivalent to the other banks, right? That's what he's saying. So, when you look at ratings, you kind of got to understand that a little bit. But it's really the price target that matters. And you could see the median is kind of in the mid 80s there. You've got on the low end some mid 70s and upper 70s, and you've got an outlier here at 95, but generally mid 80s. So, I'm pretty comfortable that that's a reasonable price target. And so then the question is, again, fundamentals. What are the banks expected to make? Now, all these analysts kind of know in the bank's guide. And so, revenue's kind of going to increase. 2022 over 2021, not so much, but once we hit 2023, revenues are going to increase. Earnings per share, pretty flat from this year to next, so not a lot of growth in earnings. You can see the growth numbers have actually turn negative on the interest rate, the banking side, wealth management side, and then in the global side. So this is their exposure to Mexico, Chile, Caribbean, South America is a big part of Bank of Nova Scotia. About 20% of their bottom line or so is emerging markets. In general, it looks more like 15% or so of their revenue, but a higher percentage of their bottom line and so forth. So, more sensitivity to emerging markets, and when there's volatility in emerging markets, it can underperform. But that's kind of the look ahead. And I've looked at 24 and 25, and the data there isn't really complete. So you don't get a real big look ahead on the banks here beyond next year, from what I have on Bloomberg. And so, not a lot of upside, but maybe not a lot of downside. So we can look at a PE much better on a mature, stable company than we can on a Shopify that is actually not, a mature, stable company and don't actually have any profits yet to share, where banks have massive profits and share a huge percentage of that in their dividend with shareholders. So you could see, based on the forward earnings expectations, that relative to the last decade or so, historically a bank would trade at 10 to 12 forward multiple, right? And you can see that, you draw that line through there, and based on the circumstances where it's trading. And so right now on a forward basis, it seems pretty cheap. So the banks and their dividends here are really attractive, from that perspective. And from a tax loss selling perspective, if we see some of that in the coming weeks, Bank of Nova Scotia in the mid 60s to me is pretty attractive. Okay, so you can see it on the chart based on the ranges and so forth. I wouldn't expect it to get back to the 80s and 90s, but you can clip a nice coupon here on Bank of Nova Scotia, as long as you buy it well. And if it dips back into the 60s or lower 60s, or buy some more, because again, good long-term stable, and I wouldn't worry about it too much from that perspective, even in a recession. And if we are going to get a recession next year, which seems likely, then that's a very good possibility. But that dividend is pays daddy for a while here. So I like it. It's oversold, and this is a name that it's time to put in the bank here, or look at it in terms of buying the dip. So let's have a look at, on a sector basis, some of these thematic ETFs that I really like. Cloud computing. We're going to look at some of the names in this sector. But here's something there. It's now back at pre-COVID levels. So the entire bubble of COVID and all that easy money is out of the stock. And so now it gets interesting to me from a value perspective and a long-term trend perspective on a sector that I think is going to outperform, long-term. And when you look at the names in here and what's in there, oh, look at there's Shopify. How about that, right? So again, here's a way to get exposure to the cloud. You got Salesforce in there as a CRM for a lot of businesses. Akamai Technologies is a great company, and it's a name that I own, and they make money, and that's, so I like that. When you again look at this ETF, it tries to hold an equal weight exposure. Now, as they move around, it moves and then it rebalances, but they're basically trying to hold an equal weight exposure. We've got 38 names in the portfolio. Here you're seeing the top 16 by weight in terms of holdings. So, I really like cloud in general. And if you look at Akamai here, it looks kind of interesting to me. So it's underperformed the cloud. So this relative strength here line tells us it's underperformed the S&P 500, you know, since we started here. But to me, relative to the price target, again, you can see analysts kind of chase it up a little bit, and then they stay high, and then it comes down, and then they come down as the stock comes down and adjusts lower and so forth. Company guides a little bit lower. So let's have a peek at Akamai here, peek into the cloud. So forward-based earnings projections, adjusted earnings as they call. So, you know, for the next year or so, that, you know, not a lot of 10% earnings growth, but really 24 and 25, if you read what the analyst said, they're going to see a lot more growth in earnings. 23 contained. I would argue that maybe if we're in a recession, it's going to be flatter than that. But these guys are in a growth sector. They help companies do it better. And I think there's, when we talk about investing in productivity, this is a company that stands out. So I really like it from that perspective. From a forward-based earnings perspective, this is stock that's not trading at a crazy multiple. And again, if you looked at it where it was a year ago and so forth. So, you know, how do you own it? How do you trade this name? And so when I look at a chart, right, and I look at it and I say, you know, we had a number of years of resistance and it broke out, obviously, you know, and now it's back, old resistance, now support. You know, let's throw a trend line here, and I cut off these lows and it's not a great trend line, but there's a trend there and you can see it with the eye as the company grows. So where do you want to buy this? You want to buy it when it's oversold. So right now it's not. You pull back to the trend, anywhere in this box looks interesting to me. So I've pulled up an option chain here for December. So if we're going to get tax loss selling, we're going to get it in the next couple of weeks, and December option expiry, you know, could be ideal. So to me, the recent lows below 80, it's attractive there. I can write a put for a month today, and I could probably get about, I don't know, 70, 80 cents for it. You know, trading at 90. You know, it could be, as we're doing this webinar, it could be at 87, I don't know, and these options will be worth more, but you could take that premium and earn it. But what I love to do is called a ratio put spread, okay? So I can buy a put on Akamai for 85, and I'm gonna pay, based on these prices, probably 145, full offer 150, but I could probably get it for 145. And then I can sell two puts, mid-market 80, maybe 65. So I can pay $1.45. Let's do easy math. I'm gonna pay $1.40 for this, and I'm gonna sell it at mid-market. I'm not saying you're gonna be able to do that, but let's say we can. So I'm buying one unit at 85, selling 2 units at 70, sorry, at 140, 2 units at 70, at the 80 put. So that means I'm going to be long an 85 put and short 280 puts. And if we get a sell-off, and by December 16th, this is at $80, it's the best of both worlds. I make $5 on my put, and if it's at 80 or below, I get to buy what I want to own at 80 at the bottom of this trend channel, and I love the trade. And I've made money as the stock pulls back. So that's one way of doing it, or you could write any one of these puts at a level that you think you might want to buy the stock and earn the premium while you wait to buy it. So there's a lot of ways. Now, do you want to buy it right now? You know, and on Akamai? You could, absolutely. So let's page back here and look at it and say, well, the analyst price target's a little bit over 100 here, and it's trading at 90. So, you know, for a tech stock, I got 10% upside and the risk reward and a falling 200-day, and it's going to be tough to break out without the markets moving. So, at 90, I don't want to own it here. So I don't, but I've got options on the name to buy that pullback with those ratio put spreads. And that's kind of how I'm liking to do it here. So we've got a couple of minutes left. Let me get into some Q&A here. Couple questions came in this week on FTX. And one of them is in general on what I feel about cryptos and why is it being compared to the Lehman Brothers scandal in the media. And I don't know why. It makes no sense because Lehman wasn't a fraud. It was a colossal failure of common sense. It was a CEO that was arrogant and believed, they put the whole company at risk because he just believed he was smarter than the market. And, you can read Larry McDonald's book, Colossal Failure of Common Sense, about that whole period. But I won't get into that. But fraud sometimes is very difficult to detect. The other question that came in about the risk, I think on Monday today, Genesis was another exchange where there's tangential credit risk. And so, we can have a look at cryptos in general. So let me bring up my screen here and let's look at the Bloomberg cryptocurrency monitor. Let me just blow up the screen here so we can. So again, this is Monday evening. We're doing this taping before my surgery tomorrow. Keep reminding everybody of that. So crypto firm Genesis had to warn of bankruptcy with new funds, and that came out after the market. And so, what are the cryptos doing? So this is a live Bloomberg ticker with all the kind of the major top crypto crap. Dogecoin trading at 7 cents. I remember when, Elon was pimping this thing at 50 or 60 cents and said he was going to accept Dogecoin as payment for Tesla. And anyways, I just shake my head at the hubris, that follows this sector. And anyways, I think all these things are worth exactly what the next person are going to pay for it. And these are speculative assets. I can't drill that home enough. There's no way that you can do a fundamental analysis. And I know people have tried and they've compared it, limited supply, and I've heard all that nonsense before. And I'm willing to debate anybody on the planet here that when the history books are written, decades, 100, 200, people are going to look back and they're going to talk about the South Sea bubble, and they're going to talk about tulip bulbs and the 1929 crash and the Great Depression and the crypto crash and the COVID crash and the 1987 crash and all the famous crashes. And this is going to be one of them where they were saying, listen, there was a lot of really, really smart people that thought tulip bulbs were worth thousands of florins. So these aren't things that are going to die, but they will die if the next person isn't willing to pay a higher price. and we'll see how long it lasts. But obviously, it's been proven to be a lousy inflation hedge. It's proven to be a lousy replacement for gold. What it's proven is to be a volatile, uncorrelated asset that if you include in your portfolio, I'm not calling you a fool, but because, it's not right to do that, but this is not something, folks, that you invest in. I don't care what the name is. Now, a comment on blockchain, a comment on, Ether, coding and what these languages and decentralized finance opportunities, what you're going to see with these is Congress is going to have to, they need to be regulated. The trust factor now is broken beyond belief. Like Wall Street broke the trust factor with the nonsense of leverage on leverage on leverage. And they're doing it again, mind you, but the balance sheets are in better shape. But there are those things out there, and financial instruments and contagion risk. And the crypto market got to be $1 trillion at one point. So there's meaningful wealth in here that when it collapses and you go through these periods, it does have knock-on effects. And I think it's kind of very very real. And anyways, I think these things are all worth zero. And there's no getting your money back on a fraud. Bernie Madoff, I think they got 60 or 70 cents on the dollar, and it took a decade. So if out of the $3 billion or whatever in these loans that they take, these insiders have taken personally, they can sell real estate and they can crystallize some assets. Maybe 50 cents on the dollar some of these people get. But I got to say, Ontario Teachers Pension Plan, what were you thinking? What did you miss in the due diligence here? Was this guy such a con artist that he pulled the wool over everybody's eyes? And again, a lot of smart private equity people got duped here. So tip of the hat from that perspective on how smart he was. But this is going to go down in my mind bigger than Bernie Madoff. So good question. How does it work? It takes a long time. The guy who liquidated Enron and those assets is now in charge. So you got a great person who understands all this stuff. Expect 5 to 10 years before anybody gets any money back. And maybe on the crypto coins, there's very little. I don't know. But the lenders that lent to them, the creditors, the asset holders, if there was fraud there, I'm not sure. So TBD on that. Okay. Nuclear. Yeah, let's have a look at that. What's the best way to invest, and when is the stigma going to subside? So the stigma is going to subside never. If you look at nuclear, so I use URA. There's a couple of ETFs that play the sector. This is the uranium miners, and you can look at it, relative to a benchmark. So in this case, the S&P 500. There's no earnings target for uranium. You could look at individual companies. So CCJ. You can look at Cameco in the U.S. and that's going to have a price target on it of what the analysts think it's worth. I've been writing puts on this name to buy it below 20 for months and months and months, and actually I've been earning 2, 3, 4% a month while I've been waiting to buy it, and so far I haven't bought it. And so that's kind of, to me, where value is here relative to volatility in the name. And I don't own any. And when I have owned it, and I have, I've been a seller in the mid to upper 20s and rinse and repeat. And I've been doing that for a couple of years now with Cameco and with the uranium ETF. So, how you play it? Do you play the Cadillac and the biggest producer in the world, or do you play it in a broader basis? Again, if I put URA up here, and you say, well, what do I own if I do that? and you look at it and you say, okay, you own some Sprott and Next Gen, and so that's what you end up owning on a weighted basis if you're playing uranium. Sibanye-Stillwater is a name that I own, South African miner that is in that space, Uranium Corp, Paladin, and Denison Mines, and so forth. So you can see all the names in there that you end up playing. And if you look at the biggest weight, there you go. It's not surprising. It's Cameco at about 22%. So anyways, that's kind of the ETF version and the stock. You could play some of the junior ones. I don't do enough work on them to matter. I would rather look at the Cadillac and trade that effectively. And so again, if you look at Cameco, so let's look at that. The U.S. market's more liquid for me, so I look at the U.S. names. But if we look at the options here, could look at the 20 put for December. Where was that? Look at that chart. Let's see if I can get volume up here. So if you look at this, on Friday we had 1,500 and change. So I was 1,000 of these. So I was 1,000 of these on Friday, and I think our average was 23 cents. If you look at, see if I can look at the quote recap. So I'm going to earn a little over 1% on this for a month. And if it gets below 20, I end up getting to buy it. So that would be pretty cool here. And if we look at the quote recap here, it's 29. Maybe my average price was closer to 30. You can see all these units trading. A lot of that is me in there. Anyways, so folks, we're pretty much out of time tonight. Actually, let me see if I can get to a couple more questions. Dell Technologies. So let's have a look at Dell here. I'll put Dell in here because again, this is a pretty interesting name here. And from a tax loss harvesting perspective, you would look at the name, year to date, and you would say that maybe there's a candidate there. It hasn't come down that much, but at the lows, only a month ago, it was very oversold. 2 standard deviations on the relative strength line, very oversold. Would I buy it here? And the answer is no. So I would look to the options market here, and I would look at, if you liked it down here and you think that's a good low, where was it pre-COVID? And you look at that level, and that was 26, and it got down to 14. So, to me, the mid-20s would be more attractive. And so I would be patient here. Somewhere in the low 30s, you can nibble at it, in there, maybe half a position, so that if it got into the mid-20s, you would want to buy more, not necessarily stop out. So let's have a look at the option chain here as to how we could do that. And I think the next market low might be in March or April. So let's call it Q1, and let's look at the April options again. You look at the March ones too, and then you would say, okay, I can buy a 35 put, pay about $2 for, and I could probably sell 2 units of a 30 put and pay and get $1 for it. Again, I'm rounding. You might be in a little bit of a debit position if you did that trade, but if it pulls back to 30, you're going to make $5 on the long, and then you're going to buy it at 30, exposing it to either earning the yield or buying it outright at 30 or lower. So, that's how I would play it here. At 41, not a lot, not really interesting to me. And I would wait for a little bit more of a dip. And last question here tonight. Thoughts on the Canadian housing market and where the current opportunities are. In the US, you can buy, they have home builder stocks, but here in Canada, there's no public home builder. You do have REITs, but they don't own, individual homes. So there's not a great way to play that. If you look at some of the mortgage companies that do lending to homes, they're a proxy for it. But I think I saw today where Home Capital Group, if I'm not mistaken, so there was an offer, someone went to buy these guys, but these guys are, a mortgage lender. And that might have been a good, tax loss selling potential there. But anyways, I saw the deal there. There aren't really any good ways to play it. Banks are a decent proxy for it, but it's not direct housing. You would really have to look, if you're looking at housing. One of my favorite names here would be DH Horton, and these DR Horton, sorry. And these guys are producers of average price homes, not high end, like Pulte, tends to be the big custom homes where these guys are the average kind of home, and very interest rate sensitive. And again, if we look at a chart here and go back, let's go back 5 years and say where's this, pre-COVID. For it to be attractive, it's got to be kind of mid 50s. But if we're going to need a lot of average price housing because of the demographics, which is the case in the US, these guys are well positioned in that market. And if you can buy this in the low 60s, I think it's pretty compelling. And when we look at some of the fundamentals, and we look at, on the forward basis, they're expected to obviously be in decline. They're going to sell less homes now with interest rates going up and so forth. So their earnings are going to take a big hit. But if we can look a little bit forward here and maybe have a peek at what the analysts say for the next few years, not a lot of growth relative to 2022. So that was kind of an anomaly. So let's call that an anomaly, and then let's kind of smooth this out through here. Obviously 2020 being a bad year. Not a lot of growth coming to the home builders here, okay, from that perspective. And so you got to think of it then as a range trading type name. And so that's kind of how you got to think about it. But when we look at the value here, you got this stock trading at, a trailing P of 4, but really a forward P of 7.8. So not really expensive at all. And then you say, well, the dividend's kind of So again, how much do you want to buy where it is relative to a pullback? And again, here's another great candidate for an option strategy, trying to buy this in the low 60s on the next pullback. And again, when is that going to be? Let's look at February options here and say, okay, Larry, I want to buy something. And so here again, you can buy a 62.50 put for $1.40. You can sell 260 puts. You can make 250 on this one, something like that. You can get paid a credit. You can get paid by a 62.50 put for $1.40 full ask, sell 2 for $1. You're taking out 60 cents. You're making 1%, where you get to wait for a few months and try to buy this on what's the equivalent of the dividend. Anyways, folks, that's it for relative strength, relative analysis, a little bit on the fundamentals, a little bit on the tax loss selling. Cross your fingers. everything goes okay, and we'll see you next week. Have a good one, everyone.